today I want to talk about how to sell every investment property you own for up to 13% more in less than 30 days. And I don't say this a lot, but nearly guaranteed, okay? And it's by having a deal strategy in order to create yourself long-term passive income while not being a landlord, guys. So let me dig right into it. This is how you do it. I'm gonna give you the step play-by-play. This is no BS. I've done it myself. I've helped others do it. This is a portfolio selling strategy that works. You just have to be anticipating a little bit of accounting work, a little bit of tax preparation, and a little bit of snazzy, jazzy deal structuring. Okay, let's dig into it. First thing you want to do is you want to get all of your calculations for every one of your investment properties in alignment. And what I mean by this is that you need to have your financials perfectly in up-to-date, real-time condition. And what I mean by this is you need to know what your net operating income is, your gross operating income is, your price per unit, gross rent multiplier, cap rate. You need to know your expenses. You need to understand what the taxes are. You need to understand what the insurance is. You need to have a financial blueprint of everything that you currently own, property by property, as well as portfolio as a whole cumulatively. And that includes running an APOD, an annual property operating data calculation, and looking at cap rate so that you can look at the valuation of your property pre-appraisal. Second step, I want you to pay for an appraiser to appraise all of your properties, every single one, both from the income approach, sales comparison approach, whatever they're going to do in order to appraise your properties properly, as in a portfolio or individually, however you suggest. But long story short, every single one of your properties needs an appraisal. Third step, now you're going to look at what those appraisals are at versus what the market is selling at, and you're going to put those properties on the market with a real estate broker. Yes, I said it, you will pay some commissions to a real estate broker if you're not a broker already yourself, and you're going to put those on there for cash or owner will carry. That's right, the terms will not accept any type of loan unless we do this strategy and you can't sell it with cash or owner carry first. The reason I'm asking you to put cash and owner carry, even though this is an owner carry strategy, is that you never know what's going to happen if you get an amazing offer all cash, over asking, or too good to be true, or just exactly what somebody else wants. You got to be able to entertain cash offers, because what you can say at the minimum is no, right? So really, this owner carry strategy is about putting not that entire portfolio up as one purchase, because now you're only going to be able to have a small buyer pool of people that have the liquidity in order to meet your down payment requirement. But you're going to put it on the market, and you're going to understand and build the framework of the deal the deal structuring framework. And what I mean by this is that if you're going to offer owner carry, you need to know that before you put it on the market. What interest rate, how long of a term are you willing to offer? What type of down payment for each of the properties are you willing to take at a minimum? And ultimately, how long are those terms in relation to what your net to seller will be for capital gains on an initial take versus your long-term interest income, and how long you'll take that from an amortization calendar. So what I am really saying is your long-term passive income gains, your interest earned over the term, right? And I don't want to get into prepayment penalty and other attorney jazz that is highly regulated in the mortgage industry, but what I really am trying to say is, how long are you going to carry that note? What is the down payment requirement, and what is the interest rate that you're going to charge? You need to figure out that framework. And every property may have different parameters of that. One might be a 15-year note at 30-year amortization rate. Some may be 30-year amortization rate all the way out. Some might be a 5-year note, balloon payment due at 5 with a 15-year amortization rate. So talk to your accountant, talk to strategic people who understand owner financing, because I'm not going to give you that advice right now. So long story short, Now you have all your properties on the market. You're going to get a bunch of calls because people are going to think because you're offer owner financing, you're going to be accepting some ridiculous low down payment. That is not always the case, but the properties that were low performers for you in your portfolio, that may be smart to take a low down payment, get it into contract, and start earning interest income without being a landlord. That's right. You're not the one doing repairs. If they foreclose, you're going to get all that down payment money and all that acquisition cost that you essentially were given to in the front, and they're going to reconcile that property, or sorry, they're going to give up that property and you're going to get it back when you foreclose on them. One of the biggest questions I get in this strategy, guys, is what happens if people foreclose? Is it going to cost me money to do those foreclosures? Yes, that is a cost of doing business. That's what every bank or mortgage company has to deal with, right? But if you're going to make if you're going to turn a $250,000 property into $685,000 in total revenue earned with interest income, it's a risk you're going to take, right? You gotta not get stuck on the out-of-pocket attorney fees or pre-foreclosure or foreclosure fees, or the accounting fees, or the time and bookkeeping it takes each year to send out those statements and get the collections going. On the note of collections, and the reason I'm talking so fast is you got to really understand this stuff, guys. When these sales close, you're going to use an escrow collection company that is going to take money from the buyers each month. And if it's all inclusive in terms of taxes and insurance that are also in that, and a total PITI payment, you're going to be able to collect them through an escrow, and you're going to be able to get your money back after the taxes and insurance are paid for by the buyer. So ultimately what I'm trying to tell you is that you're going to get mailbox money every month that is principal and interest on the purchase price of that property for the long term or the length of that loan. Before I go into refinancing or prepayment penalties, what I will say is this, guys. Sometimes you can lower the purchase price and increase the interest rate to attract way more buyers. Sometimes you can decrease the down payment requirement and slightly decrease the purchase price because you're making it up over the long term of the loan, right? Sometimes you can increase the purchase rate but decrease the interest rate, or sorry, purchase price and decrease the interest rate, so that you can create these variables that I'm not going to tell you how to do. You need to figure out yourself on how to market each one of your properties. And let me give you an example. If you have an amazing investment property that has a great cap rate, a very good on-market gross rent multiplier, and a good cash flow number, and you look at the DSCR, debt service coverage ratio, of what they're paying you each month if they own or finance to them, and what cash flow they're making on top of that property, right? You can increase the purchase price because it builds and develops cash flow as they build equity, right? Same thing you would be doing if you were holding on to the property and paying a loan off on it anyways. But if you have another property that is something that has tons of deferred maintenance, it doesn't cash flow that good, the tenants' problems are always coming up in that area, sometimes you can decrease that purchase price, right? Decrease that interest rate to get it to be competitive, or it has demand, and get rid of it, but just look at your long-term gains. Look at your 5-year gain, your 10-year gain, your 15-year gain, and that rolls us right into refinancing. The number one question I get when I tell people this strategy is, what happens if somebody cashes me out using a refinance? Now, I'm not going to talk about prepayment penalty because they're highly regulated, but what I'm going to say is this. If you use this strategy to sell every single one of your properties at the purchase price that you would have sold on market anyways, or roughly within 5% in each direction, why does it really matter if somebody calls you and says, hey, I bought your property for $250 3 years ago. It looks like I'm going to do a refinance on it and I'm going to pay you off. I don't want to pay your interest rate anymore. You're like, cool. For 3 years I made interest and I got the price that I wanted to sell it for anyways. Now I have to pay capital gains on it. It is like anything in life, guys. It is the pro and the con of every type of strategy. It is the pro and the con of every single strategy. You can't do everything in life and have it all work out your direction. There is push and pull. There is pro and con. So when you're telling somebody this amazing strategy on how to sell all their properties in 30 days, strategically price them, how to make long-term passive income, how to create notes and not be a landlord, then I get a bunch of questions or objections about all the things that could go wrong, or all the things that you have to deal with, or all the time commitments to properly preparing those properties in terms of taxing and bookkeeping and all of it. So I'm telling you this, guys, because you have to work hard at things to make more money. Generally speaking, I'm not saying that everything in life is like that, but this strategy is based upon having a solid accountant, having a solid attorney, having a solid contract and promissory note, deed of trust, having a great title company, and having a firm understanding and an appraisal of your property, so you understand what are you giving up in terms of purchase price now, in terms of equity forecasted, versus what your interest income would cover in a local market. And what I mean by this is that if you're making 5% on your money in a market that appreciates at 7.5%, maybe it doesn't make sense to do this. But if you're in a market that ebb and flows and you're looking at 3.5% appreciation, which is quite average unless we're having a big upswing, 5% on your money, 6% on your money is key. It's double. So let's kind of review everything I said, because I speak very quickly on this stuff because there's a lot to cover in a 15-minute video. If you have a portfolio of properties or you have a few rental properties, this is the fastest way to selling them when they are free and clear. Disclaimer, this entire strategy is for people who own 100% of their property and don't have loans on them. I don't want to talk about subject to transactions. I don't want to talk about acceleration clauses. I don't want to talk about somebody thinking you can owner finance a property that already has a first position lien on it from a bank or a lender, because it gets into a lot of complex legal stuff. This strategy is for people who have a lot of properties that are paid in full. They own 100% of them, and or they have the cash to pay off the notes in order to start performing this strategy. Okay? Let me disclaimer again, I am a real estate broker in the state of Oregon. Everything I said today is for educational purposes only. It is not for implementation purposes without getting the right advice from people, right? What I am trying to tell and help people is from an investor advice standpoint, not a real estate broker standpoint. So there's two perspectives with this. When I talk about investments and I talk about the strategy, I'm talking from an investor perspective. When I talk about real estate transactions, details, terms, those types of things, I'm talking from a broker perspective. So whatever interest rate you want to charge, whatever term you want to charge, whatever long-term capital gains deferment you're trying to achieve, you need to call your accountant, you need to talk to your attorney, you need to talk to the right appraiser, you need to talk to the title, commercial real estate broker, residential broker, whatever it is. But ultimately, if you want to sell all of your investment properties in less than 30 days for up to 13% more, you're not going to do it just listing it cash conventional. You're going to have to look at this as a long-term deal structuring sale strategy. And I've written a book about it, a small ebook, nothing crazy, not a New York Times bestseller. I'll have a link below on this video. But when you put all this stuff together, I always use this analogy, you put it in the blender and mix it up. Sometimes, guys, it does not make sense to do this. And what I mean by that is it's just your property mix, your location, your area, your buyer pool, your income you're producing on the properties, your level of deferred maintenance, guys, just doesn't make sense. It doesn't make sense. So my advice is to give you the idea. Your advice is to look at all the pros and cons, ask the own objections you have to the strategy, and ultimately make your own professional decision if you'd like to do this. What I will tell you this in perspective of storytelling is that I wake up every 3rd of each month. It's February 3rd or 4th today. I check my bank account for my income properties. and I have all of the rental properties that I have property management duties to. I have all the properties I have on notes in a separate account. And it's about 50-50 in terms of income being produced. But my expense ratio is nearly zero on the note portion of that portfolio. On the properties that I have to play property manager and deal with repairs, deal with tenants, deal with property management, expense ratio is 25, 35, 45%, depending on what type of property it is. So you got to ask yourself, guys, 5% expense ratio or average 30, 35% expense ratio? What is your willing of comfortable investing? What are you willing to deal with? What type of dream team do you have assembled around you? And where are you in your investment career? The most important question, guys, at the 15-minute mark is, where are you in your investment career? Because this strategy is where I suggest investment downsizers implementation at that point of their life, right? They're not going to do a 1031. They're not ready to amp up things and buy a bigger complex or do any type of expandability of their portfolio. What they're trying to do is retract their liabilities and increase passive income. Detract expansion, I don't even know if that's the right word, and increase peace of mind. It's a downsizing strategy. It's a liquidation strategy. On the extreme would be liquidation by auction. On the not so extreme would be selling those properties just on the market for cash and paying your capital gains. This strategy that I have tried to share with you guys is somewhere in between those two strategies, but the income potential is way higher. So if you have any questions, contact information is below. Shoot me an email, follow my stuff on YouTube, follow me on Instagram at Oregon Real Estate Expert. Everything that I put in this video, everything that I talk about day by day by day is actually happening. This isn't some content generation idea grab or steal that I stole from somebody else. This is actual things that are happening in the business that we are doing, and we're sharing it free of charge, no coaching, none of that garbage, about helping other investors build long-term wealth through real estate and not make the same damn mistakes that I made when I did. So if you have any questions, everybody, happy investing, go make more money. And don't forget, if you want to sell every investment property for 30 days for up to 13% more, do what I say. Take care.